Hello, my name is Jorge Tezen, and today I will be explaining three financial ratios, its concept, and examples for application. The acid test ratio or quick ratio is a more conservative liquidity test than the current ratio. This indicator shows more precisely the availability for the payment of short-term debts. For this, we subtract the inventories from the current assets and divide them by the current liabilities. The reason why we exclude inventories is that we assume that the company is not conditioning to the sale of their inventories in order to pay debts. This is especially important in those companies where the inventories are not easy to carry out, or in companies in commercial decline, which due to their situation cannot guarantee a timely sale, so they cannot guarantee timely payment of their debts if they are guaranteed with inventories. For example, if the indicator were less than 1, it will mean that the company depends directly on the sale of its inventories in order to meet its current obligations. If the ratio were greater than 1, it will mean that if the company had the need to meet all its current obligations, it could do so without liquidate and sell its inventories. Finally, it is important to have in mind that eliminating the inventory account does not guarantee better liquidity, since the quality of account receivable should be considered, since a difficult to collect portfolio may be eventually presented. If accounts received have a slow turnover, it is recommended to subtract this item from the calculation of the acid test. In general, the slowest turnover account is eliminated. The inventory turnover allows us to identify how many times the inventory turns into money or account receivable. With this, we determine the efficiency of the use of the working capital of the company. For this, we divide the cost of goods sold among the total of inventories. This means that if, for example, the turnover of the inventory during 2016 was 6 times, or in other words, the inventory were sold or rotate every 60 days, 360 divided 6, the goods remain 60 days in the warehouse before being sold. The higher rotation, it means that the goods stay less time in the warehouse, which is a consequence of the good administration and management of the inventories. If we see it from the side of the days, the lower the time of stay of the merchandise in the warehouse, the lower will be the cost of working capital invested in the inventories. A company that sells inventories in a month will require more resources than a company that sells its inventories in a week. Let's remember that any immobilized resource that the company has without need is an additional cost of the company, and having inventories that do not rotate, which are almost not sold, is a negative factor for the company's finances. It is not profitable to keep a product in a storage for a long period of time because of the opportunity cost that it represents. Inventory turnover is one of the most used indicators for management control related to logistics, or even for the commercial department of a company. It is very important value since the rotations gives an account of the number of times stocks have been renewed, either for an article or for a raw material during a period of time. Return on assets is a profitability ratio that indicates how much profit a company is able to generate from its assets. In other words, the return on assets measures how efficient a company's management is in generating earnings from their economic resources or assets on their balance sheet. For this, we divide the net profit among the total assets. ROA is shown as a percentage, and the higher the number, the more efficient a company is in managing its balance sheet to generate profits. A negative ROA indicates the activity generates losses. This parameter has been used to follow the evolution of a company over the time. However, it is important to compare companies of similar size and industry. For example, banks tend to have a large number of assets in their books in the forms of loans, cash, and investments. Although the bank net income or profit might be similar to an unrelated company, and the bank might have high quality assets, the bank's ROA will be lower. So it is important to take into account what types of assets are required to function in a given industry rather than simply comparing the figures.